Morgan Housel on X wrote that he spoke to an investor who said, quote, "If the market actually processes what happened yesterday, it would be down 30 to 40%. The fact that it's not is either denial or a belief that it will soon be reversed." Now, if you don't know who Morgan Housel is, he's the author of The Psychology of Money. If you have not read this book and you're serious about money, you absolutely need to. It is by far the best financial book that I have ever read. I mean, I've read Rich Dad, Hard Dad, How to Start Your Own Business Bible. I've read Josh Brown's book. I've read Intelligent Investor. Like, they're all right here. This one now is really old. It was in my car for a while. I had a bit of sun damage. I've read them all. And that's by far the best. By a long shot. And this is what I've been saying, okay? That if these tariffs actually stay in effect, it's like Trump nuked the economy, okay? How do you price that in, accurately reflect that risk of the unknown? How long do these stay in effect? Do they not stay in effect? Do they get paused, canceled? Is there a deal that's worked out? It's really hard to say. And that's why over the last 2 days, the NASDAQ is now in a 22% drawdown, officially a bear market, and the S&P is pretty close behind, falling almost 5% on Thursday and almost 6% on Friday. I mean, this is a bad market. Now, there are signs out there that a short-term trading low could be coming, probably next week. And here in this video, we will go over the economic data that we have, earnings that we have, and why I think this low could be coming. But don't be fooled. The real question is, are we going into a recession? How long do these tariffs stay in effect? If the tariffs are paused, markets are going to love that, but it's still going to be uncertainty. And we're already tariffed by China. So what kind of retaliation do we see? That's also a big question. Now, surprisingly, you've already seen a lot of countries kind of back down from retaliation. Canada and Mexico seem to be okay with the current situation. A lot of Europe does not want to retaliate. Some countries do, like France, but a lot of Europe does not want to retaliate. China, they've retaliated. Some of the big news on Friday was that Vietnam wants to drop their tariffs to zero, essentially in exchange for the US to drop their tariffs to zero, in which that's kind of what we're presuming. But we don't know what's going to happen. Now, in this upcoming week, we have earnings from Levi's and Dave & Buster's Monday in after hours. Pre-market, you have Walgreens Boots Alliance, you have WD-40, you have Tilray. Tuesday and after hours, nothing really notable. Wednesday pre-market, Delta Airlines. Wednesday and after hours, Constellation Brands. Thursday pre-market, CarMax. And Friday pre-market, you have JP Morgan, BlackRock, Wells Fargo, BNY, and Morgan Stanley. Now, it will be interesting to see, what do the banks say about this? Bank stocks on Friday got absolutely obliterated as well. Do they, start to call for recession more? JP Morgan, they have a base case of a recession. But what does BlackRock say about this? What does Wells Fargo and Morgan Stanley and BNY say about this developing tariff situation and whether or not they think this is going to materially weaken the economy? And I think from a basic perspective of this, no matter what happens next, earnings estimates have to continue to fall. That's going to continue to put pressure on markets at the bare minimum. It's not going to be a positive catalyst for markets when analysts come out and lower price targets and lower earnings expectations. So that's another big pressure that whether we have a recession or not is going to be on this market. Now, in this upcoming week, starting off on Monday, and really like the first half of this week, you don't have much for economic data. On Monday, you have the consumer credit change, which I think can actually be important given, all of the fears in the economy. This is basically saying, what do credit card balances look like? Did they grow? How much did they grow by in the last month? You're looking at February. Okay, you're expecting 15 billion. Usually it's not a market moving catalyst, but again, if that number is negative or really low or something, that could indicate weaker spending data. Now, on Tuesday, you have the NFIB Business Optimism Index, expecting that to fall a bit, and it's been falling for a while now. But that's it. You have Fed Daily that speaks at 1 p.m. On Tuesday. On Wednesday is the FOMC minutes. Not expecting that to really move us. It's backwards looking. Markets really don't care about that. You do have a 10-year bond auction following what happened to the 10-year treasury yield over the past couple of days. That'll be important to see how much demand comes in. Thursday is your big data, CPI. So core month over month is expected at 0.3%. Last month, it was at 0.2%. So obviously, if it's higher, that's bad. If it's lower, that's good. And this is something the markets should react to, but I think it would mainly be in the bond market. Now, if inflation does not show that it's continuing to be a problem over the next couple of months, then the Fed will be able to accommodate markets. Then perhaps we can, get back to the Fed accommodating things, and that should help to support markets. Now, core year over year is expected at 3%. That would be down from 3.1% last month. Headline month over month inflation is forecasted at 0.1%. That would be down from 0.2% last month. And year over year is expected at 2.5%, down from 2.8% last month. So you're actually expecting a pretty benign CPI report, which hopefully could be good for markets. Now, initial jobless claims are expected at 225,000. They did come in lower than expected last week at 219,000. That will continue to be a pretty big catalyst. You also have a speech from Fed Logan at 8:30 in the morning on Thursday, and a speech from Fed Goolsbee at 11 o'clock in the afternoon on Thursday. On Friday, you have PPI month over month for March. You're expecting actually negative 0.1%. A lot of that probably has to do with the oil data. Oil has continued to fall, and there's been a lot of downside pressure there. So that should get picked up in PPI and have you actually at a negative number. Now, core PPI is expected at 0.0%. There's a consensus here at 0.3%, but a forecast is 0%. So you're expecting a pretty low number as well there. And we get the Michigan Consumer Sentiment Survey for April. Now, this has been a big catalyst for markets for the last 2 months. You're expecting the headline number will fall from 57.0 down to 56.4. 5-year inflation expectations expected to hold steady at 4.1%, the highest level in over 30 years. Keep that in mind. So it's just the high level that we're expecting to hold. Consumer expectations are expected to fall from 52.6 to 52.3. Current conditions are expected to fall as well from 63.8 to 63.4. 1-year inflation expectations are expected to hold steady at 5%, which is crazy in this Michigan Consumer Sentiment Survey. Because when CPI was 9% in 2022 and the talk of the town was prices going up, people did not have inflation expectations this high. Now, it's really skewed by Democrats because Democratic respondents are expecting hyperinflation, Republicans are expecting no inflation, and independents are like right in the middle at like 3%. So it's very political, if you will, but markets pay attention to it. I don't think it is very accurate of inflation expectations, but it could be and probably will be a market moving catalyst on Friday. Now, here's why I think markets are probably going to go through a short-term bottom. First and foremost, CNN Fear and Greed Index is at 4. The percent of stocks trading above their 50-day moving average is at 9. Okay, these are very extreme levels, and I imagine the new AI investor sentiment survey that comes out this upcoming Thursday is going to be really negative. The one that we had this Thursday was almost 62% bears, 16.3% neutral investors, and 21.8% bulls. That's really bad. But when you dig a little deeper and you look at the S&P, the daily RSI is at 23.43. The last time you were this oversold was the COVID crash, okay? And you hit 20. So you're almost like as oversold as the COVID crash, which is insane because last I checked, the economy was not being shut down overnight with who knew how long it was going to be shut down, right? So you're very oversold here. From a technical perspective, you're probably going to bounce. I said the same thing in early to mid-March that you were probably going to bounce based on technical factors, but that it probably wouldn't be a long-lived bounce. And I'm thinking roughly the same thing here. You're going to bounce probably in the first half of this upcoming week, but it's probably not going to be a long-term thing. Even if Trump, we get good tariff headlines, how much of it's actually going to be walked back, right? You've kind of crossed that boundary now with China retaliating against us as far as tariffs. So that's a problem. Now, could it get worse? Of course it could, but I think now the real question is, what effect does this have on the economy? Now, when you look at the SPY on a weekly candlestick chart as well, this is the fastest sell-off you've seen since COVID. This is, I mean, it looks pretty identical to COVID. But the weekly RSI is at 28. You have not been oversold like this, again, since the COVID crash when the RSI hit 21, almost 20. So you're just very oversold. No matter which way you look at it, when markets are this oversold, you tend to bounce. The problem is, this is probably not a bottom for markets, okay? Like that post from Morgan says, that he heard from an investor, stocks would be down 30, 40% if they were taking this seriously. That is, that's true. That's what I've been saying. Now, on the S&P, you're only down. Are we down that much? Stop playing. That's a lot. You're down 17.3%? I thought it was like 15%. Yeah, you're getting close to a bear market on the S&P as well. Okay, but you're not really pricing in still even that recession risk into markets, right? Because again, I've done this calculation for you guys a lot on this channel. We had about $237 of EPS for 2024. If you take 15% of that off the markets for 2025, that's about $201 of EPS. Times that by a generous recession multiple of 18, you're looking at 361 on the SPY. Okay, even from current levels after this sell-off, 361 on the SPY would take you down about 28.5% from here. So that's a generous multiple too. The median multiple during a recession is 15.5 times. If you plug in 15.5 times, you're sitting at 311 on the SPY. That's even worse of a drawdown. That's where things get really nasty. That would be 38.5% downside from here. So, I don't want to be the guy that calls this the ultimate bottom when the numbers just don't match up to that. Now, I imagine as well over the next coming week, you are going to see banks come out with more recession forecasts. You're going to see earnings expectations continue to be lowered on the S&P. And again, that's going to continue to put pressure on the broader markets. And I think this is going to look a lot like the bounce you just had, right? You bounce a couple percentage points, then you come down. Now, I don't know if it's weakening data that's going to do that. I think at this point, you need to see the economic data start to weaken. But keep in mind, the tariffs have not even went into effect yet. Okay, they will go into effect in this upcoming week. If they go into effect too, that's another thing. Is it delayed, or what funky stuff does Trump do? There's a lot of uncertainties there. But nonetheless, there's a lot of downside risk at this point. In all reality, you're down to where you were August 5th of 2024, right? During the flash crash. I don't know about you guys, but that doesn't seem like a crazy low to me, right? Once you start getting back to like 2023 prices, that'd be like 400 on the SPY. Then you're like, okay, that's a little, that's getting extreme. And that's when I would plan to put a lot more cash to work, a lot more margin to work. And I think we all kind of learned a lesson from even 2022, assuming you were investing in markets then. If you buy the dip too early and too large, you will get washed, right? It's a fine line between buying the dip, too early and too late, right? Especially if you planned on using margin. That's definitely a no-no right now, in my opinion. And there's 3 things that I am doing right now to get rich during this correction. Number 1 is I'm getting rid of anything that could be vulnerable during a recession. Imagine it like this. Small cap company needs to raise capital during a bull market. Nobody bats an eye. Stock could drop 5 to 10%. Sometimes the stock will even go higher. If you're a small cap company trying to raise capital, you're unprofitable, you need this money to survive, during a recession, your stock's going to fall like 50% that day, okay? That's not a risk you want to take, okay? It's just not. Unless it's a very small amount of your portfolio, then to each his own. I don't want to take that risk, okay? You're going to have plenty of opportunities to buy those stocks back much cheaper. Okay, so that's number 1. Number 2, I'm completely out of margin. Have been out of margin for a while now, for the last couple of months. You want to be out of margin. It's not too late to get out of margin. And number 3, you want to be hustling and bustling in your real life, at your job to earn extra money, getting a new job, doing side jobs, does not matter. Whatever you're good at. Get as much money as possible right now, because, you want to be able to put every dollar you possibly can to work on the recovery of this thing, because that's where the money is made. And even then, your cash is gaining purchasing power, right? As markets fall, your cash becomes more valuable. So I will leave it there. Again, we just went over this. The targets that you could see in markets are really low, like 2022 levels, okay? A lot of people are going to say that's impossible to get to. But here's the thing. Like we've seen in 2022, markets normally surprise you, right? Markets can normally run a lot higher than you think and fall a lot more than you think, okay? So don't get caught in that trap of trying to outsmart the markets. It's simple. Where are earnings expectations going? What is this earnings season going to have in store? The answer is probably not great things. And, Wall Street's going to have to realize earnings expectations need to go lower, and they will be going lower. And that's going to put more pressure on markets as analysts and firms lower those price targets. So, and earnings expectations. So let me know what you guys think about this down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.